Hello everyone, and welcome again to Nettle, the best platform around for distance learning in business, finance, economics, and much more. Please don't forget to subscribe to our channel and click that bell notification button below so that you never miss fresh videos and tutorials you might be interested in. Many thanks to our current Patreon supporters for making this video possible, and I would also greatly appreciate if you consider supporting us as well, so please check the link in the description for more details. My name is Sava, and today we're investigating a key concept in portfolio management, that is, how many stocks are required for an optimal diversified portfolio. You might have heard from investment analysts, from academics, that on average from 30 to 40 stocks is what is desirable for an individual investor when you seek to do passive investing and mimic the market return and market risk. But where does this 30 to 40 figure come from? Some investors or some practitioners or even some academics might say that 15 is enough or even 10 is enough. Where does this disagreement originate from? Today, we're going to investigate a quite simple and intuitive yet powerful model, that is the Mayshar 1979 model, that allows us to think about where does the optimal number of stocks originate from. The assumptions of the model are quite stringent but understandable. First of all, we assume that there are infinitely many stocks that have similar characteristics, that have similar expected returns. Here we assume it to be equal to 10%. They have similar volatilities. Here we assume that an annualized volatility of a particular individual stock is 30%, which is quite realistic. Again, we can tweak the numbers and see how the model output changes. We also assume that the stocks are correlated pairwise, and this correlation coefficients between pairs of stocks are the same. And here we just input the value of the pairwise correlation between any pair of stocks as 0.5, so 50% correlation. And we also assume some parameters for our representative investor, for an investor who seeks to determine how many stocks they should include in their portfolio. And the investor is parameterized using their risk aversion coefficient, theta, which means how much does this particular investor hate risk. So we assume that all investors are risk averse, but some investors hate risk to greater extents. And a theta risk aversion parameter of 3.5 is quite average value. And then we need to also specify what is the investable capital of the investor. How much do they want to invest in their portfolio? And here we set this value at $10,000 US. What is driving the trade-off between including more or less stocks into your portfolio is the transaction cost, and that is the novelty that Mayshar implemented in 1979. Mayshar assumed that investors have to pay a fixed transaction fee to the broker to include one more position into their portfolio. And that is generally how many brokers work. If you want to open another position, so if you want to include another stock, another title into your portfolio, then you have to pay some fixed commission to your broker. And here we assume that this transaction cost is equal to $2. So if you include 5 stocks into your portfolio, you pay $10 a year to your broker. If you include 20 stocks, you pay $40, and so on and so forth. And that drives the logic of the model. As you include more and more stocks, you gain by reducing the volatility of your portfolio as diversification benefits grow, but you also lose more and more as you need to pay more fees to your broker. And when those trade-offs cancel each other out, optimality is achieved. And the mathematics of it is quite simple, and we'll touch upon the derivation of the model formally in a closed form solution later on in the video. However, first let's approach it in terms of simulation, in terms of simple portfolio construction, and consider the covariance matrix between our stocks. And let's say that we'll go as far as 40 stocks in our hypothetical portfolio and choose which portfolio would be the best. Maybe it's 10 stocks, maybe it's 20, maybe it's 30, maybe it depends. We'll figure out how sensitive this optimal number is to different parameters. However, here we are just interested in calculating this matrix, and for the covariance matrix to work, we need to first specify whether we are on the diagonal or not. And if we are on the diagonal, so if our row number is equal to our column number, then the correlation of a stock with itself is 1, so we can just input volatility squared as our variance, because the covariance of a stock with itself is its variance, isn't it? And if we are not on the diagonal, then we need to multiply the variance, as all stocks have the same volatility as per our assumptions, by the constant pairwise correlation that's given over here, by 0.5 in our case. And we can then populate our matrix using Ctrl R to first populate the first row, and then bottom right click it all the way down to get the matrix. And unsurprisingly, we have got 0.09, which is 9% annual variance on the diagonal, and 0.045, which is 0.5 times the variance, as 0.5 is our correlation, on non-diagonal cells of our matrix. And now we can calculate risks and returns of a portfolio that is equally weighted across a particular number of stocks, and compare them in terms of investor utility and in terms of the portfolio volatility. So first of all, to calculate the volatility of a portfolio consisting of n stocks, we need to figure out what should be the weights in this particular portfolio, and then apply the usual matrix multiplication formula to calculate portfolio variance, and taking the square root, converting it into volatility. So first of all, we input the mmult function and initialize an array of portfolio weights. And that's quite easy to do. We have a vector of ones over here, so we can simply refer to this particular cell and lock the column here, so the starting cell does not change as we drag it across. Then we can refer to the same cell but not locking it, so as we drag it across, the array that represents weights is going to be longer and longer, and then we divide it by the number of stocks as our portfolio is equally weighted. And then we multiply it on the right by another matrix multiplication result, and here we have to input the covariance matrix of a size n by n. So we always start at this particular cell B11, locking both the column and the row, and then we refer to the bottom right cell of this matrix, which depends on the number of the stocks in our portfolio, isn't it? So we just refer to the whole matrix over here and refer to the number of stocks as the final row and column identifiers. And then the second array in this particular matrix multiplication result is going to be the transposed vector of weights. But we have already inputted the vector of weights, isn't it? At the start over here. So we can just copy and paste it across. And now, having finalized our calculation of portfolio variance, we can just take the square root of it and enforce the formula using Shift-Control-Enter and get a portfolio volatility of 30%, which is by all means intuitive, as if you invest everything into one particular stock, then the volatility of your portfolio is going to be equal to the volatility of this stock, which is very, very unsurprising. But now we can drag that across and figure out what the volatility is going to be for a portfolio that consists of n stocks. And we can see that it does gradually decrease, and it decreases quite fast initially. Going from one stock to two stocks is quite beneficial. It reduces the volatility by more than 4 percentage points, and later on the gains are not that high. You can see that moving from 39 stocks to 40 stocks does not even reduce your portfolio volatility by a single basis point. So is there any downward limit on how low this volatility can go, or can it go all the way to zero? Well, to do that, we'll have to consider the formal mathematics of the model. But as for now, let's just visualize some of the parameters of our competing portfolios in terms of their optimality, and can now consider the second part of the trade-off, which is the fixed cost that we need to pay to our broker. And we have to pay $2, which means that this cell should be locked, per the stock in our portfolio. So we just multiply it by the number of stocks. And then we can again drag it all across. And then consider, what does this particular fixed cost mean for our net return? Well, our net return is just the gross return of the portfolio, which is always equal to just 10%, isn't it? Because all stocks are the same. We do not reduce or increase the return when including more stocks. We're only reducing volatility by some amount. But then we have to consider, how much do we lose in terms of dollar value, so the gross transaction cost that depends on the number of stocks in our portfolio, and then this needs to be divided by the initial portfolio value. As in percentage terms, that is how you can calculate the impact of transaction costs onto your return, isn't it? And now we can just again drag it all the way across and see that our net return is constantly decreasing quite linearly, actually, as we include more and more stocks into our portfolio. It is quite close to 10% if we have 2 stocks, 3 stocks, 4 stocks, but as we include more and more, if we include 40, the reduction in net return due to trading fees is quite material. And this impact is more material if your portfolio value is smaller. Paying $10 is quite negligible if you have invested $1 million, but it can be quite destructive if you only have $500 to invest. So it means that potentially more affluent investors would have the luxury to form more diversified portfolios, while less affluent investors might need to find peace with a less diversified portfolio of 4 or 5 stocks, for example. And now, finally, having calculated the net return and the portfolio volatility, we can use the Arrow-Pratt utility function for an investor that factors in portfolio variance, portfolio net return, RP, and the risk aversion parameter theta that we have assumed to be equal to 3.5 initially. So we can calculate our Arrow-Pratt investor utility by first inputting our net return, RP, then subtracting the risk aversion parameter theta, and we'll lock it here as it doesn't change from portfolio to portfolio. It is constant for a particular investor, divided by 2 and multiply by the portfolio variance, which is, unsurprisingly, portfolio volatility squared. And now we can see how the change in the number of stocks in our portfolio affects our portfolio volatility that we've just calculated and the investor utility. So here, for this particular parameterization, we can see that, as we have already figured out from the numerical values in the cells, volatility of a portfolio first responds to an inclusion of an extra stock quite sharply, dropping quite rapidly over here, but then the incremental gains are quite small, whereas the penalty for including more stocks, which is the transaction fee, remains constant. And that is what leads to optimality in this particular framework. As we look at utility, we can see that it is increasing until we have got around 20 stocks in your portfolio, and that it slowly diminishes. And here we can already figure out what affects the optimal number of stocks, isn't it? Volatility does, as you can diversify away more risks. Correlation between the stocks does, as if we have less correlated stocks, we can reach more attractive diversification benefits by including more stocks. And obviously, fixed costs and the capital the investor has investable do affect the optimal number of stocks as well. But also, risk aversion does affect the particular investor's optimal portfolio, as investors hating more risk would be willing to take on more trading fees to reduce their risk by some fixed amount. However, to formally derive the closed form solution, we have to drag ourselves through some not so complicated mathematics. So if we consider the variance of a portfolio consisting of n stocks, we have to calculate the variance of a sum of random variables. And as we've got n stocks in our portfolio, and they will be all weighted in equally with a weight of 1 over n, and we need to figure out the variance of this particular sum, 1 over n of x ith, which is the ith stock from the selection of n stocks. And here, remembering the properties of the variance of sum of random variables, we can drag this 1 over n in front of the parentheses squared, so we'll have 1 divided by n squared over here. Then we'll have sum of n individual stocks variances, which is going to be n times sigma squared being a variance of a single stock and n being the number of stocks. And then we would have the sum of all potential pairwise correlations between stocks. And that can be easily calculated using the triangular numbers or the combination of two values of two elements from n, and this formula is n times n minus 1 over 2, which pops out in many unexpected areas in modeling and mathematics and finance and economics, you name it. And this particular constant is the number of covariances that we have to add up to this particular value. And keeping in mind how we calculated the covariance between any pair of stocks, we just have to multiply the squared volatility, as volatilities of any stocks are the same, onto the correlation coefficient that is again assumed to be the same and 0.5 in our model right now. And now we can simplify it and do some trivial algebra over here and arrive at this particular equation. So here we see that we've got a component that does not depend on the number of stocks, rho, that is the correlation times sigma squared, and we have got a component that has n in the denominator, which means that this is the component that gets reduced, that gets diversified away as you include more and more stocks into your portfolio. We can even find the limit of portfolio variance as the number of stocks tends to infinity as we diversify our portfolio indefinitely, and it's easy to see that this particular expression would tend to 0 as the denominator tends to infinity, and this particular expression will stay the same as it's independent of n. So we can see that the portfolio variance, as you include more and more stocks into your portfolio, cannot go below rho times sigma squared. And that means that portfolio volatility, which is the square root of variance, could not go below sigma times the square root of the rho, the correlation coefficient, which is the lower bound of our diversification benefits. And that is what leads to the trade-off and the optimality in terms of the number of stocks. So formally, to find the optimal number of stocks, we can consider the utility function in terms of the expressions we have just discussed. So here we have got our gross return R, and then we adjust it to our trading costs, and our trading costs in dollar value are just fixed trading costs per lot, per position C, times the number of stocks N, and to convert it to return form, we just divide it by investable capital K, and then we just subtract the portfolio variance, which uses this particular formula we have just derived, multiplied by theta divided by 2. So this is just the Arrow-Pratt utility function parameterized in terms of our variable in question n. And we can only vary n in this setting because everything else is either fixed or characteristic of our particular investor. So we can find the optimal number of stocks n by taking the first derivative of the utility function with respect to n. And here we see that r is the constant, so it goes away. This is a linear function in terms of n, so we just got the coefficient minus c divided by k over here. And right here, we have got this term that's independent of n, so it vanishes. And this particular constant can also be brought forward, and we are left with minus 1 over n as something that we have to differentiate. And as the derivative of 1 over n is minus 1 over n squared, this minus turns into a plus, and we have got n squared in the denominator. And then we can easily see that if n is small, then this particular component dominates. So it means that initially, when the number of stocks is small, it's beneficial in terms of utility to increase the number of stocks in your portfolio. However, when n is large, this particular component starts to dominate as this tends to 0, and you lose utility. You make yourself worse off by including extra stocks. And that means that there indeed exists an optimal number of stocks in the portfolio when the value of this particular derivative is equal to 0. And just applying some simple algebra and rearranging the terms, we can express our optimal n star as a function of the initial model parameters. And we can see that it's positively related, linearly related to portfolio volatility. The more volatile a particular stock is, the more stocks it can be beneficial to include into an optimal portfolio. It is positively related to risk aversion theta. It is positively related to investors' investable capital, K as well. And it is negatively, inversely related to the trading costs, C. We can also see that as correlation increases, the optimal number of stocks also goes down, and vice versa, simply because the more correlated stocks are, the less diversification benefits you can get from including more stocks into your portfolio. So let's use this formula and calculate, as a closed form solution, the number of stocks that makes our investor the best off possible. So over here, let's keep in mind the formula that we've just derived and translate it into language of Excel. So first of all, we need to take the stock volatility and multiply it by the square root of risk aversion theta times 1 minus correlation rho times our investable capital K, $10,000 in our case, and divided by 2 times the transaction cost C, which is $2 per position in this particular parameterization. And then we enforce the formula and get the optimal number of stocks to be approximately 20. And that's exactly what we see here graphically, as the utility curve does indeed seem to peak at around 20. Also, we can change our parameter values and see how the optimal number of stocks will change as well. So if our transaction costs, for example, reduce to 1, then we see that 28 stocks are now optimal. And that's something that immediately is reflected in this particular utility graph. If, on the other hand, we return to the initial setting and increase correlation to be 0.8 instead of 0.5, we see that now 12.5 stocks approximately are optimal, as less diversification benefits are achievable in such a setting. And we see that that is indeed the case in terms of our portfolio volatility curve, which does flatten out much sooner than it did before, and our optimal number of stocks is indeed around 12. And if we do, for example, reduce our risk aversion, if we say that we are now less risk averse, then the optimal number of stocks is 15, as we are less mindful of the risk and we would rather save a little bit more money on trading fees for our broker. And that is also reflected in the charts as well. Finally, something that I wanted to show before we wrap up the video is how to calculate the portfolio volatility in a more concise way with the formula we've just derived over here and not relying on the bulky covariance matrix. Indeed, we have actually derived a closed form solution for portfolio variance, so the square root of it is going to be portfolio volatility. So we can just take the square root of the first term and plus the second term. So 1 minus our correlation, which is reported over there, times the variance of a particular stock, so volatility squared, divided by the number of stocks, which is reported over here, and that changes with from portfolio to portfolio. And then we can add rho sigma squared, and we've got the rho in cell B3, and we've got sigma squared as B2 squared. And then we close the parentheses, taking the square root, and we can enforce this formula throughout and see that it does indeed capture the same value as the more complicated formula dealing with matrix multiplication. And that's all there is for the Mayshar 1979 model that can be used to derive the optimal number of stocks for a passive investor. Please leave a like on this video if you found it helpful. In the comments below, I'm eager to see any further suggestions for videos in business, finance, or economics you would like me to record. And please don't forget to subscribe to our channel or consider supporting us on Patreon. Thank you very much, and stay tuned.